What if I told you that a delay in a Swiss diplomatic summit, an empty apartment building in Florida, and the electric bill for a massive artificial intelligence server are all secretly dictating the price of your digital assets?
I mean, I'd say you're looking at the exact same institutional filings I am.
Right. Well, welcome to the week that was. We take a massive stack of recent market reports, institutional filings, and, on-chain data, and we just extract the absolute most important insights for you.
Yeah, forget the daily price charts. We are looking at a market that's caught in this massive structural tug of war.
Exactly. On one side, we have tightening global monetary policy, and then on the other, rapid institutional financial engineering.
Right, and all of this is happening while evolving regulations are just desperately trying to keep up. It's a profound structural shift.
It really is.
We're watching the entire digital asset landscape recalibrate in real time, It's moving away from being this speculative technology experiment and into a fully integrated pillar of global finance.
Yeah, and our mission for this deep dive is to cut through all that noise. Because if you are trying to navigate this space, you need to understand how these seemingly random disconnected events across the globe actually form the plumbing of the financial system.
Absolutely.
Okay, let's unpack this starting with the macroeconomic shockwaves. Because it feels like digital assets are no longer existing in their own isolated bubble, right?
No, not at all. They are acting as highly sensitive, hyper-reactive proxies for global macroeconomic tides.
Right. So let's look at Japan, because the Bank of Japan just raised its benchmark rate to 1.0%. Now, that might sound tiny to some people, but it's actually the highest borrowing cost they've had since 1995.
Yeah, and that 1.0% is a seismic shift for global liquidity, specifically because it disrupts this mechanism known as the yen carry trade.
Okay, break that down for us.
So for years, institutional funds have utilized a very specific, highly lucrative strategy. They borrow yen because the Japanese interest rates have historically been, at or near zero. So they take that incredibly cheap capital, immediately convert it to U.S. dollars, and then purchase high beta risk assets. They are essentially capturing the spread between the 0% loan and the high-yielding asset.
And in today's market, Bitcoin is often utilized as that premier high beta asset.
Exactly.
Okay, let me make sure I'm getting this. The carry trade is basically like using a low-interest credit card to fund a volatile tech startup. And suddenly the bank jacks up the APR, forcing you to scramble.
That is precisely the mechanism at play. When the Bank of Japan raises rates to 1%, the cost of servicing that massive system-wide debt suddenly spikes.
Oh, wow.
Yeah, so these institutional funds are instantly forced to unwind their positions. That means they have to sell off their risk assets like tech stocks and Bitcoin just to buy back yen and cover their rapidly compounding loans.
But what we saw in the market recently was uniquely fascinating, right?
It really was, because retail speculators already held heavily leveraged short positions, expecting a massive crash. The rate hike actually triggered a violent short squeeze.
Wait, so the price went up instead of down?
Yeah.
How does a forced sell-off cause a price spike?
Well, it comes down to market positioning. There were so many traders betting the price would collapse that when the initial selling didn't immediately break key support levels, those short sellers got nervous.
Ah, I see.
Yeah, as the price ticked upward, their exchanges forced them to buy back the asset to cover their short positions. That algorithmic buying pressure just cascaded.
Right. The data showed over 70,000 traders faced forced liquidations.
Yes, wiping out hundreds of millions of dollars in short positions as the price rapidly climbed into the squeeze.
Which brings us to the geopolitical side of the equation. Because, algorithmic trading models were already incredibly stressed out and scrambling.
Very true.
We had this major geopolitical whiplash involving the United States and Iran. They drafted a 14-point memorandum of understanding to essentially end a 4-month conflict and reopen the Strait of Hormuz.
And the reopening of the Strait of Hormuz is critical plumbing. It directly impacts global energy supply chains.
Right.
When the blockade lifted, we saw global oil prices drop sharply. Lower energy costs immediately reduce forward inflation expectations. And if inflation is dropping, that theoretically gives central banks more room to lower interest rates and ease fiat liquidity conditions.
But then the formal signing of this agreement, which was supposed to happen at a diplomatic summit in Switzerland, was indefinitely postponed.
Right, due to sudden border conflicts in Lebanon.
Yeah.
If we connect this to the bigger picture, Bitcoin is currently trading less as a decentralized technology play and almost entirely as a pure reflection of these fiat liquidity conditions.
Because when the peace agreement was initially announced, Bitcoin didn't drop alongside oil.
Well,
Right.
no, it didn't, which it absolutely would have if it were acting as a geopolitical safe haven. Instead, it rallied in tandem with U.S. technology equity futures. The market was pricing the peace deal purely as an indicator of future monetary easing.
But the moment the Switzerland summit was delayed, algorithmic models immediately had to reprice that risk.
Exactly, stripping those speculative liquidity premiums right back out of the market.
And speaking of monetary easing, or, well, the severe lack thereof, we have to talk about the Federal Reserve. We are officially in the Kevin Warsh era at the Fed.
Yes, we are.
For his first meeting as chair, he held the benchmark rate steady at the 3.50 to 3.75% range. But the actual interest rate isn't the real story here. The real story is the dot plot, right?
Correct, the summary of economic projections. The dot plot, which maps out where each Fed official believes rates will go in the future, has entirely inverted.
Wow.
Yeah. Previously, the vast majority of officials projected rate cuts. Now 9 of 19 officials project at least one rate hike instead of a cut.
That is a massive shift.
It is. Furthermore, Chair Warsh has effectively eliminated forward guidance. He stated the bank will operate strictly on a meeting-by-meeting basis, looking only at immediate data.
And for a non-yielding asset like Bitcoin, that introduces immense price uncertainty.
Absolutely. When you can get nearly 4% risk-free from a government bond, the opportunity cost of holding a highly volatile, non-yielding asset remains extremely high.
Which perfectly explains why capital is so expensive right now. And because the Federal Reserve is keeping capital expensive, Wall Street and corporate treasuries are engineering highly creative, backdoor methods to secure yield.
The sheer scale of the financial plumbing being built right now is unprecedented. Let's examine BlackRock.
Okay.
Despite seeing some net outflows recently from spot ETFs overall, BlackRock's spot Bitcoin ETF, IBEA, has reached a staggering milestone. It now generates an estimated $187.2 million in annual fee revenue.
Which officially surpasses the fee revenue of BlackRock's own flagship S&P 500 ETF. That is wild.
It really is.
The Bitcoin fund is generating more fees for the world's largest asset manager than their core S&P 500 fund. And they aren't stopping there. They just launched a new actively managed ETF under the ticker BITA.
Right, which actually writes covered call options against Bitcoin to generate monthly premium income for investors.
But I have to ask, does capping the upside to generate a little monthly cash defeat the whole purpose of holding a highly volatile asset in the first place? I mean, if you want fixed income, buy a bond. Why cap your gains on Bitcoin?
Well, it's a great question, but you have to look at it from the perspective of an institutional portfolio manager.
Okay.
For traditional income-focused investors, like pension funds or retirees, dampening that volatility is actually a feature, not a bug. They are often mandated to generate consistent yield.
That makes sense.
Yeah, a covered call strategy allows them to capture the historically high implied volatility of digital assets and mechanically convert that volatility into a predictable monthly fiat cash flow. But an even more brilliant mechanical structure is emerging from Franklin Templeton.
Right, the DRP ETFs. When I was looking through the filings, this completely blew my mind.
It is a highly sophisticated, automated accumulation pipeline. Franklin Templeton's new hybrid funds allocate 95% of their capital to traditional U.S. equities and 5% directly to spot Bitcoin.
So it's mostly just a boring, normal stock portfolio.
Exactly. But here is the underlying mechanism. They use a dividend reinvestment plan, or DRIP methodology. When those traditional companies, say Coca-Cola or Johnson & Johnson, pay out their quarterly fiat dividends, the fund automatically intercepts that cash.
And immediately uses it to buy spot Bitcoin on the open market.
Yes.
Okay, so stop right there.
Yeah.
The traditional economy people buying soda and Band-Aids is essentially funding an automated, relentless Bitcoin purchasing machine.
Precisely. It creates constant programmatic buy pressure, completely detached from market sentiment. And they have strict risk management rules baked in.
Like what?
Well, if price appreciation or dividend accumulation pushes the Bitcoin allocation above a 20% hard cap, the fund executes an emergency rebalance. It automatically sells the crypto back down to a 4.5% baseline.
But if the asset is appreciating, why force a sell-off? Aren't they capping their own clients' gains just to fit a rigid algorithmic rule?
They are, but for a very specific reason, which is fiduciary discipline. Traditional finance thrives on predictable risk parameters. If Bitcoin goes on a massive bull run and suddenly makes up 40% of a client's retirement portfolio, that breaks the risk profile the client signed up for. By hard-coding a 20% cap, they force the portfolio to take profits at the top of the market and redistribute them back into stable equities.
And it isn't just Wall Street funds doing this. Private corporate treasuries are innovating too. Cardone Capital, which is a massive real estate syndication firm, is using unleveraged rental income from their multifamily commercial properties to buy Bitcoin.
That's right.
They have a stated goal of accumulating a 3,000 Bitcoin treasury. Imagine a family paying their monthly rent for a two-bedroom apartment in Miami, and that exact fiat cash is instantly programmatically converted into a fraction of a Bitcoin sitting in a corporate cold wallet.
The physical real estate market is literally being used to mine digital scarcity. And the absolute key word there is unleveraged.
Right, because they aren't taking on debt.
Exactly. By using organic rental yields instead of borrowing money to buy the asset, they completely insulate themselves from the kind of margin calls and liquidations we discussed earlier with the yen carry trade. It permanently removes that liquid inventory from the secondary market.
Meanwhile, you have Cathie Wood's ARK Invest rotating capital completely out of the traditional tech sector, selling off massive shares of AMD, Tesla, and Robinhood.
Yes, to fund a massive $443 million position in SpaceX, the capital reallocation across the board is moving at lightning speed.
So Wall Street and corporate treasuries are building these massive automated accumulation machines. But that immediately raises a massive red flag for Washington, because who is actually policing the valves these machines are running on?
Well, that's exactly the issue.
We are seeing a sharp divergence in how different agencies and different nations are treating digital capital.
The courtroom battles we are seeing right now will define the market structure for the next decade. The most significant is the Chicago Mercantile Exchange, the CME, filing a 42-page lawsuit against the Commodity Futures Trading Commission, the CFTC.
So what does this all mean? It sounds like two different referees fighting over what sport is actually being played on the field while the game's already happening.
What's fascinating here is a legal nuance. The CFTC recently allowed platforms like Kalshi and Coinbase to offer perpetual futures contracts to domestic users.
Right.
Now, a traditional futures contract usually has an expiration date. You bet on a price by Friday, and on Friday the contract settles. But a perpetual future doesn't expire. It rolls over endlessly.
So how do they keep the price anchored?
To keep the contract price anchored to the actual spot price of the asset, they use a funding rate. It's a small fee exchange directly between the buyers and the sellers at regular intervals.
Okay, so if the contract price is trading too high, the people betting it goes up have to pay a fee to the people betting it goes down, bringing everything back into balance.
Exactly, but the CME is arguing that this continuous exchange of cash based on an underlying asset's performance without an expiration date isn't a future at all. By definition, they argue it is a swap contract under the Dodd-Frank Act.
And why does the difference between a future and a swap matter so much to the CME?
Capital mandates. Swaps carry massive clearinghouse capital requirements because they are historically seen as carrying high systemic risk.
Oh, I see.
Yeah. If these instruments are legally redefined as swaps, it imposes crippling collateral costs on these emerging platforms. The CME is essentially trying to force native digital asset exchanges to play by the most expensive, restrictive rules of legacy finance to protect their own market share.
Which is incredibly timely, because Coinbase is simultaneously pushing hard into traditional finance territory. They are rolling out 24/7 tokenized equities. We are talking about traditional stocks trading on-chain, around the clock, with verified dividend distributions. But while federal regulators fight over swaps and futures, state regulators are launching their own attacks. The Kentucky Attorney General is currently suing Polymarket and Kalshi.
Yes, claiming they are operating unlicensed gambling platforms. This highlights a deep tension in the United States legal system.
How so?
Well, the federal government, via the CFTC, explicitly classifies these prediction markets as commodity event contracts. But Kentucky is attempting to use state-level consumer protection and gambling laws to override that federal classification.
And then you have the banking regulators stepping in regarding stablecoins. Under the new Genius Act, federal agencies are proposing Customer Identification Program rules, CIP rules.
This would force stablecoin issuers to verify customer identities exactly like a traditional commercial bank does when you open a checking account.
That is a massive shift for crypto.
It is. Traditional banking lobbies argue that non-custodial wallets represent a major anti-money laundering gap. They want the primary issuers to be legally responsible for monitoring and potentially blocking secondary market transactions.
So if you hold a stablecoin in a private wallet, that means the original issuer could theoretically freeze it at the behest of a regulator. That is a massive regulatory net tightening in the U.S.
It really is.
But when you look globally, the contrast is stark. Let's look at Argentina versus Ireland.
It's a perfect contrast. In Argentina, President Javier Milei just eliminated the 1.2% check tax for registered virtual asset service providers.
Which is huge for market makers.
Exactly. Historically, that tiny tax made institutional market making completely unprofitable through official banking channels, which drove all the trading volume into the unregulated peer-to-peer shadows. By eliminating the tax, Argentina is trying to pull that liquidity directly into the formal regulatory framework.
Lowering friction to capture the capital. But Ireland is doing the exact opposite.
Right. Ireland just launched a strict 30-point action plan enforcing the European Union's travel rule to track illicit flows.
What does that mandate exactly?
It mandates that platforms must verify and transmit the identity data for both the sender and the receiver of any cryptographic transaction. So while South America is creating tax exemptions to attract volume, Europe is building an expansive surveillance apparatus to track every single movement of capital.
Which means the underlying foundational networks have to evolve just to handle all of the surveillance and institutional adoption. Moving from the courtroom to the server room. The foundational hardware and software networks are undergoing a massive shift.
They are.
They're primarily pivoting toward artificial intelligence, while bad actors are exploiting entirely new vulnerabilities.
The infrastructure pivot is perhaps the most fundamental change in the industry. Let's look at Bitdeer Technologies. They recently reported a massive 370% surge in their Bitcoin mining production.
Here's where it gets really interesting, because their actual mining output isn't even the main story.
Not at all.
They are converting huge portions of their global power capacity to AI computation. They are deploying NVIDIA GB300 clusters. They already have a $69 million annualized run rate for their AI cloud division, and they are literally dismantling existing mining centers in Washington state just to make room for AI servers.
Yeah, it's wild. So mining companies are tearing down crypto hardware to build AI data centers. Are they just chasing whatever the hottest tech trend is, or is computation the real ultimate commodity?
This raises an important question about the true value of these infrastructure companies. What Bitdeer and others have realized is that their actual moat, their true competitive advantage, isn't the specific mining rig itself.
Right.
The moat is their legally binding access to multi-megawatt power contracts and their advanced industrial cooling systems. Those physical resources are incredibly scarce.
That makes a lot of sense.
Whether the server plugged into the wall is calculating a cryptographic hash for a blockchain, or training a large language model for an AI, the underlying energy infrastructure is the ultimate commodity. The electricity and the cooling are the real assets. The servers are just interchangeable tenants. Now on the software side, the Layer 2 networks are upgrading to keep pace. The base network is deploying a major architectural upgrade to its testnet called Barrel.
The Barrel upgrade is highly technical but crucial. It introduces the B20 token standard. Currently, tokens rely on isolated smart contracts at the application layer to function, which requires a lot of computational energy.
Okay.
The B20 standard embeds that token logic directly into the protocol-level node software.
So by building the rules directly into the foundation rather than running them as separate applications, it uses less energy, which translates to lower gas fees for you and me.
Considerably lower. But more importantly for institutional users, the upgrade transitions their bridging infrastructure to a new multi-proof system.
How did that work?
Traditionally, a Layer 2 network like Base bundles up thousands of transactions and sends a single proof back to the main Ethereum chain. If someone thinks that proof is fraudulent, there is a 7-day dispute window where they can challenge it. That is why your money gets locked up for a week when you try to withdraw.
Right. Back up. What exactly is a multi-proof system? Are we talking about different layers of security checking each other's math before letting the money leave the network?
Exactly. Instead of relying on one type of mathematical proof, it requires several different proof mechanisms to verify the batch simultaneously. Because these different mathematical models are checking each other's work in real time, the network requires less time to achieve certainty.
Oh, I see.
Yeah, that permanently reduces the mainnet withdrawal latency from 7 days down to 5 days. Capital velocity is everything for trading desks, so unlocking capital 2 days faster is a massive structural advantage.
But with new infrastructure comes entirely new threats. Microsoft just flagged a severe malware strain called Trojan.Win32 Crypto Bandits A.
That one is particularly nasty.
It is. This isn't just an email phishing scam. It spreads physically via USB drives, creating self-replicating clones. Once it's on a machine, it installs a hidden Tor client and actively monitors your clipboard.
Right.
So when you copy a crypto wallet address to send funds, it imperceptibly swaps that address out for the hacker's address before you paste it. So how does that actually work in practice? Are they just hoping I don't notice the address changed?
They are exploiting human laziness. Usually when you paste a long string of characters for a wallet address, you probably just glance at the first 3 letters and the last 3 letters to make sure it pasted correctly.
Guilty. That's exactly what I do.
The malware knows that, yeah. It generates a custom vanity address on the fly that perfectly mimics the first and last characters of the address you copied. It only changes the middle characters. So you check it, it looks fine, you hit send, and the funds are gone forever. It highlights that the weakest link in digital asset security is almost always the user endpoint, the actual laptop or physical device.
That is terrifying.
And we are seeing these cyber threats scale up to the sovereign level. We saw reports that hackers completely breached the property and water billing databases in Islamabad, Pakistan.
Oh, man.
They paralyzed the municipal digital revenue systems and demanded a ransom payment denominated entirely in Bitcoin to restore access to the city's water billing framework.
Holding an entire city's infrastructure hostage for digital assets, it really puts everything into perspective. So bringing this all together, how do we synthesize the week that was?
If we step back, what we are watching is the final transition of a market. It is moving from being a purely speculative, isolated technology experiment into a deeply integrated, highly financialized asset class.
Right.
Think about the journey we just mapped out. This is an asset that now reacts directly to Japanese interest rate hikes. It relies on Wall Street dividend reinvestment pipelines for automated spot accumulation.
It's the subject of massive jurisdictional turf wars between federal and state agencies over the definition of swaps.
Exactly, and the physical infrastructure backing it is in direct competition with artificial intelligence for global electricity.
And if you are listening to this right now, that is exactly why keeping track of these diverse, moving parts from macroeconomic carry trades to state-level lawsuits and USB clipboard malware is the only way to truly stay well-informed without getting completely overwhelmed by the daily noise. You have to see how the plumbing actually connects.
I'll leave you with one final provocative thought regarding that physical infrastructure. Consider the Sultanate of Oman. They just officially launched Oman, which is a state-backed mining pool.
Okay.
But here's the catch. They mandated by law that all local digital asset miners must route their hash power exclusively through that state-run pool. If sovereign nation-states begin controlling the physical consensus infrastructure by law, eliminating voluntary pool selection, what happens to the core philosophy of a borderless, decentralized network?
Now that is something to mull over. When the states start regulating the actual hash power, the game changes completely. Just like we said at the start, that old financial x-ray machine we used to rely on to clearly diagnose the global markets, it's broken. We are navigating incredibly complex waters, but we will keep charting them for you. Thank you for joining us on The Week That Was.